Hi everyone. So last time we left off with the conventional cost analysis for Baldwin, and the conclusion here was fairly simple that there was a 31% ROI, and because it only required working capital investment, and fundamentally the project was a go from that the management was really excited about it, but we are going to switch gears into strategic cost management analysis, and what this would suggest is going to be a combination of different things. And we are going to look at the value chain analysis and also strategic positioning analysis. Again, if you don't know what they exactly mean, we are going to cover more in depth in the subsequent chapters. But we are really looking at is based on Baldwin's value chain. Where is they best positioned in terms of serving the customer, and which segments are they? So in this particular case, what the authors spelled out is here: anything over $300 in terms of retail price is a premium brand. Anything between 150 to 200 is sort of the value brand. And then there is the cheap segment, right? Anything below 150, I should say, where and Baldwin is operating in the value segment, and the proposal is coming to more to the cheaper segment. So Baldwin is currently in the 150 to 200 range. And that's again based on a particular structure, right? So what the current deal arrangement is they sell through about $110 to the dealers. So that's not again what the end customer is going to be charged. This is what the dealer will be charged by Baldwin. And let's assume that there is a shipping cost of $10, and that gives them a delivery cost of $120. So ultimately, what happens is that is the Baldwin and the company, in this case Baldwin, charges its dealers about $120. So let's assume the dealers have a premium branding concept that say, hey, we love the notion of supporting Baldwin, and we believe that it's the upper tranche, so the value segment, so it's in the $100 to $200 range. And Baldwin is basically on the higher end of that range. So from dealer's standpoint, they'd like to the product be around $200, so they can garner about 40% margin, and that's what they charge to the end customer. Now, this is the kicker. Basically, the end customer gets charged around $200, right? And we are going to switch gears now to the high value deal. From a value chain perspective, it supports a very different segment. All right. So if a high value needs to be somewhat competitive in the market, it's going to be closer to $100 to $150 mark. So what we see here is the average selling price to high value from Baldwin is anywhere between $92 and plus the $8 shipping cost, it comes to $100. And it's a less shipping cost because it goes to one distribution facility of high value, and then it's going to go from there. Now, from a high value perspective, the margin that they would charge is and cannot exceed, let's say, 25%, because if they start creeping above that and go towards 40%, they are going to basically start approaching the value segment. So they are no longer in the cheap generic brand, and their sales are going to suffer. So high value's ideal price point is between $100 to $150. Let's assume 25% margin, so we are going to get about $133, and that's what going to be taking. So the key takeaway from this slide is this represents a fundamental shift in Baldwin's business model. They have changed the service offering substantially enough whereby they are no longer operating as that high-end $200 bike. They have now actually come down quite a bit to $133. And recall, in terms of material differences in parts and features, there isn't really much difference between high value and the current bike. You might be thinking, well, how is it possible? Is Baldwin ripping people off? Again, let's not go into the semantics of, is it possible in the real world? And many would contend that you will see this really much in the real world. And this example is not. Is this example far from the truth? And the answer is probably not. I think you have a lot of Baldwin type of business models out there where there is little or no differentiation between their current products versus what they could be manufacturing cheaper and private label segments. But the crux of it isn't necessarily to attack Baldwin's marketing strategy or try to think about their marketing strategy from perceived value of a bike. The crux of it is, from strategic cost analysis standpoint, is about what particular segments you want to operate in. So if you intend to take high value deal as Baldwin executive, you are basically thinking about is, I need to fundamentally change my business structure and realign my business structure to meet this particular new segment. And I can no longer operate as a premium brand and invest heavily in R&D. And I need to think about high volume, low cost manufacture. So that's the crux of this. We will develop this thought process a little further in the upcoming slide. But that's pretty much what it is. And this here is sort of computing, is the gamble worth it? And the model that we are going to leverage shares the DuPont analysis. The company DuPont has basically broken out return on equity into various components. So if you recall from the earlier lecture, currently Baldwin's garners about 8.2% in return of equity, and that's basically taking the profit and dividing it by equity. Now, how do you break that? And this is a demonstration of the breakdown. So you have the profitability, which is price to sales. That's the first particular metric. So that's 2.3% in that particular metric. And then you multiply that times the intensity, asset intensity, that is meaning for every dollar of an asset that you deployed out, how much sales do you generate? And then the last one is the leverage. So it's the asset divided by equity. Higher these numbers, the better they are, right? So intuitively, the higher profitability, the better it is. The higher asset intensity is a good thing, because you are basically going to generate more sales on every asset that you deploy out. So you have a very scalable model. And then lastly, there is the leverage. And leverage is a double-edged sword. Typically, if you are able to leverage a lot of your equity, that means you are able to go in the market and borrow at fairly cheap rate and generate high profits. Having a high leverage ratio doesn't necessarily mean a bad thing, but it does put a constraint on your company to generate growth. Meaning, if you have a high leverage ratio, you have a very high fixed cost in terms of interest expenses. The way you would defend this part of the DuPont analysis, basically to generate high enough volume or defend high enough margin so you can cover those costs as it relates to leverage. So again, leverage is a double-edged sword, and we would contend that in this particular industry, in the manufacturing industry, the higher the leverage, the more risky it is, because if there is a recession or something that happens to a particular company, it's going to get hit hard. They need to pay their interest for sure. That's the only given in an uncertain environment. So what we've tried to break down here is, how am I going to get these numbers, right? So the three different components: margin, asset intensity, and leverage, and how you multiply that to get to return on equity. So the first row you see here is the 8.2%. We have already seen in the conventional cost analysis. That's based on the balance sheet and the P&L that we have covered. And with high value deal, this particular slide is going through the mechanics of showing the incremental profitability. How you come to 31% ROI. What is the new return on equity, which is a much higher number, and in that case, it's 13%. So what you see in green is right here is an increase and represent good things. The arrows in red represent additional risk and or the downside. When we break down the DuPont analysis from a risk standpoint. And then on this slide, lastly, we are comparing that to the US manufacturing sector as it relates to bikes. And this is what authors put together as an assumption in the case study. They basically said the return on equity in this particular segment is as high as 15%. Margins are again a lot higher than Baldwin, and asset intensity and leverage is also quite different. Now, what does this tell us? What's the big takeaway here? Again, we've worked through the few mechanics. DuPont analysis is a great tool to understand different scenarios. We are clearly seeing that our ROI is improving. It's below the US manufacturing, but we would contend if you were a manager sitting in Baldwin, you would argue that, hey, I'd rather be at 13% than the 8.2%. The challenge is when you have an asset to equity ratio that's about 2.8 and your peers are only at 2, you are including substantial risk into the system. And what's really happening now is relative to your industry, you are going to be perceived as more risky. So the question from strategy standpoint is, how much of a guarantee is there that I can actually pull off this high value deal? So far, all we talked about is taking the author's assumptions and coming up to a number that's fairly easy to do. And we would argue that most companies would have adequate data to put together something together in this format. The challenge is now taking the next step where you really have to think about the scenario analysis. Can we actually hit these numbers? Can we actually go from 8.2% to 13%? And where are the risks? And that's again where strategic cost management will come into play. Now, going to the next slide, what we'll see is a simple break-even analysis. We have an average selling price of 110. Again, that's what you give to the dealers. And we have a margin of, say, they have a margin then of, say, 40%. And basically, you have your gross margin. And our contribution margin here is around $44. Our fixed cost, which is manufacturing plus SG&A, let's say is about $3.9 million right here. And the break-even analysis suggests that you have to sell about 88,636 bikes to break even. So again, nothing revolutionary. What you've seen in the past, you've probably seen very similar analyses like this before. What we are really looking at is our fixed cost, and we are dividing it by contribution margin per unit. And let's look at the future model. This is the key difference here. You'll notice the average selling price is going to drop from 110 to 92. And again, this is fundamentally Baldwin being in a new market, and assuming, of course, that there is a good information in the market and your customers have a decent understanding that Baldwin bike and Challenger bike has no difference in price. So that is potentially a future model that you are going to go into. Now, we are not going to say that's going to happen for sure. The point being that this could happen, and again we will go through the same break-even analysis, and what we see is we need to sell 169, close to 170,000 units that needs to be sold to cover the $3.9 million in the fixed cost. Or the other option is you keep everything the same, but then you have to lower your fixed overhead from 3.9 to 2 million. So that's a decrease of 47% in order to get to the back to the 88,636 units. So you either need to sell more, definitely, or you need to cut your fixed overhead substantially to break even to come to your current model. And that's the point of the analysis. So the DuPont analysis clearly establishes this strategy is risky, and we are going to take a lot of leverage on your balance sheet, and that is we are going to take a lot of debt, and investors are going to ask the question, wow, you are putting a lot of capital into this plan, you are basically going all in terms of high value deal, because there is a high value proposition here. We've clearly demonstrated that you can go from 8.2 to 13%, but from sensitivity standpoint, which we came here, is like, is it worth the gamble? How much do my sales have to increase if my customers start moving away and start thinking me as a low value bike? And that's a low priced bike as opposed to the medium priced bike. And what this suggests is, they either have to double their sales, literally from 88 to 169, or they have to cut their fixed cost drastically. So the risk here really is that the question you might have if you want to jump from 88 to 169, is there really a market to support this? And we would argue that under both scenarios, what you would see is if you are going to go fundamentally change your strategic positioning and your value chain. That is, here you're either going to change your product offerings from 110 to 90-ish, and you need to basically cut yourself off, or you are going to change your value, where you are going to cut most of the fixed cost and most of the fixed overhead cost and basically reduce it by 47%. And instead of actually maybe manufacturing bicycles here in the US, maybe they will go and outsource to another country. And that's what we mean by fundamentally realigning your business, right? So you can sell off your factory here and you go into more a variable cost model to some variable cost country. But both of those scenarios are going to put a lot of strain on Baldwin, and it really seems unrealistic within the year. Again, recall you have a risk-averse management team with really thin margins, and you are up for refinancing this year, and you have to pull a miracle potentially in 1 year in order to be able to defend this. So it's something to think about from a strategic cost management analysis perspective. Now, does this mean that the conventional cost analysis is wrong? No, it's just different, right? So you are looking at it from a different angle. It's sort of seeing this in a completely different way. So a scenario analysis would say one thing to do is to go the other way, or just say from strategic options standpoint, I'm not going to even think about the high value segments. In fact, I'm not even going to think about the $200 segment. Why am I selling my bikes for $200? Shouldn't I be selling them for $300 to $400 mark if my sales are going to be declining anyway in this particular segment, right? And shouldn't I be the elite segment in terms of niche markets, like changing to specialty bikes like mountain bikes or alternative terrain bikes, or bikes for folks with maybe handicaps, whatever it might be. Um, we should go and start looking at those, utilizing that excess capacity to introduce a new product line altogether. Or can we aggressively invest in R&D to try to reduce our fixed overhead costs and move into higher average selling price segments? So that's one option. The second option is what we already discussed, is to become fully dedicated low cost producer. So let's get out of this weird medium priced market and let's just go to the lower price, which is $120 to $150. And lastly, you just don't make any change. You can just stay where you are. You can be unprofitable relative to the industry. It may be you are not a going concern long term, but you can at least think about what's the best approach for this particular problem. So just giving yourself time essentially before you react to something drastic, whether you specialize or go lower cost. Maybe you need to do more research, maybe hire consultants, and maybe put yourself up for sale. What if High Value would be interested in buying Baldwin outright, right? So there is a lot of different options as management can exercise by just delaying an option, because delaying an option inevitably gives you a very key asset, which is information in this case. You can operate with more assumptions and with more information and operate more confidently going forward. So we will leave it there. Basically, the key here is under the conventional cost analysis with 31% ROI, it looked like this project should be a go. It's not wrong from basic mechanics standpoint. Anyone would argue that this is the right way to do it, but how you should be approaching is the big picture. It looks very different from strategic positioning framework, which is the second vector in the strategic cost analysis. It becomes clear when you are really shifting your business model. You can potentially dilute your brand significantly, and that's a big risk, especially with your existing customers. So when you think about it, doubling your sales or cutting your fixed overhead by 47%, neither of those are very feasible in such a static market. The risk is certainly very high to pull off this scenario. And if you put your strategic cost management hat, what you would come up with is say, oh, wait a minute, 31% sounds great, but under the conventional cost analysis, but I really need to think about this a little bit more. I think there is just more than is here than just clear profits and walking away with nice margins. There is actually a big risk here that we could lose our company altogether. So we will leave it here, and in the next lesson we are going to basically jump into value chain analysis. Thank you everyone, and then I will talk to you in the next lesson.